Good afternoon, everyone. Thank you so much for being here. My name is Katie Johnson. I am the director of the MBA program at Western. I'll act as the host for today's event. In just a few minutes here, I'll pass it over to Dr. Dolar. But first, I'd like to start by acknowledging that Western Washington University's main campus is situated on the ancestral homelands of the Coast Salish peoples who have lived in the Salish Sea Basin all throughout the San Juan Islands and North Cascades watershed for time immemorial. We express our deepest respect and gratitude to our Indigenous neighbors for their enduring care and protection of our shared lands and waterways. This afternoon, the College of Business and Economics and the WW Alumni Office are excited to welcome you to today's webinar, Where We Are Headed, the U.S. Economy in 2025. Our speaker today is my esteemed colleague, Dr. Barak Dolar, an accounting and MBA faculty member who has been at Western since 2012, just a little before I joined. I'll pass it to Barak again in just a minute so that he can properly introduce himself. But first, a couple of housekeeping items for you. So for those of you that submitted questions with your registration, we have shared those ahead of time with Dr. Dolar, and so he will either address those questions in his presentation or we will revisit as many of them as we can during the Q&A session at the end. On that note, as we move through the presentation, please do use the Zoom Q&A feature, which should be at the bottom in the middle of your screen. You can send us any questions there as we go, and then we will try to get through as many of those as we can once the presentation is done. Finally, we recommend that you do use the speaker view as part of Zoom, just tends to work a little bit better. And again, thanks so much for being here. And without further ado, I'm going to pass the torch to Dr. Dolar.
All right. Good afternoon, everybody. My name is Brock Dolar. Actually, I was looking at the RSVP list and I recognize a lot of names. So if you completed the MBA program over the last over 10 years, you must have taken my classes, 2 accounting classes, because I'm the only accounting person teaching in the MBA program. Just a little bit of about my background before coming to Western. So I've been teaching accounting here at Western, but before that, actually I started my teaching career teaching economics because I got my PhD in economics. I taught economics for 4 years, micro, macro, money and banking, and then I switched to finance and taught finance for another 4 years. So I have quite a bit of exposure to the quantitative side of business, and I do follow the markets pretty closely. So I know a lot of things are happening so fast nowadays. So we just wanted to put together this webinar just to give some sort of an idea, at least from my perspective, what is happening and what we should expect going forward. So I'm just going to go ahead and share my screen here. Just 1 second. I have a lot of things open. Oh, 1 second. All right. Okay, so as you see, the title is Where We Are at this point in 2025 and where we are headed. It's very difficult to predict even the upcoming quarter or 6 months, but basically what I do from time to time is to just go over the main indicators of the economy and markets, and I just do it for for my own sake. And just try to understand what is happening at a given point in time and maybe try to predict at least the near future. So during this presentation, I'm just going to go over the GDP situation. And then we're going to talk about employment or its opposite, unemployment, what's happening on the inflation side. So nowadays, you can't really look at markets or the economy without actually thinking about government finances. So maybe 5 years ago, this was not an urgent issue. but it has become an urgent issue. I'm talking about budget deficits and rising national debt. So of course, we have been talking about lately imports and exports, or U.S. Foreign trade and trade deficit, rising and chronic trade deficit, which are tied to the tariff movement. And then I'll just make a few comments about the status of financial markets. This is just a quick summary of what I have, what I see at the current time, and also implications going forward. Some key summary items or themes, which I think will be important going forward this year. First things first, so economy is definitely slowing down. By some measures, we are already in a recession. But it takes a long time to decide, and this happens by a committee, which really takes its time, up to 6 months to decide whether the economy is in a recession or not. So we could be in a recession, and we may actually hear about it, I don't know, maybe mid 2025 or even the later 2025 third quarter. Accordingly, unemployment is also rising. But having said that, the labor market is still strong and remains strong, which is the main thing that is holding everything together at this point. So if we see more weakness in the labor market, then I guess the game is over, at least for this business cycle. We'll definitely go into a recession. But at this point, yeah, unemployment rate is still not very high. It is rising, but overall, the labor market seems resilient. Inflation is, as usual, a very important topic. So inflation has come down quite a bit since its peak back in 2022, 2023, from 9% to around 3%, depending on which measure you look at it. But the issue is inflation has become, unfortunately, quite sticky. So yeah, there has been a lot of progress lowering inflation, but it seems like we are at this point stuck at that 3% to 4% interval. And it has been there for some time. And of course, with the new tariff regime, it's quite likely that inflation, at least for a while, for some time, I can't really tell you what that time frame would look like, but it'll go up, maybe temporarily. Expectations are very important when it comes to inflation. Future inflation expectations are very important, and on that end, the picture has become very gloomy. So I'm going to show you some charts. Consumers going forward expect a significantly higher inflation. And expectations are important because people actually change their current behaviors based on their expectations, including their inflation expectations. We have started talking about the risk of stagflation again. So this is some major theme which keeps reemerging. Stagflation, which is the situation where the economy is not growing much, if any, or might actually go into a recession, so that's negative economic growth. But at the same time, inflation is rising, or at least it remains high. And this is the worst case scenario, the nightmare scenario for central bankers, especially central bankers, because we don't really have a solution to that problem. One good thing about inflation is, or I'm sorry, I take it back. One good thing about a recession is during recessionary periods, inflation tends to go down. So that's one positive side of, being in a recession, if there's anything positive about it. But if you're experiencing stagflation, then you might be in a recession and prices are not coming down. So what do you do in that case? That's an economic problem that we have not been able to solve over the last 50 years. When inflation was first happened, that was mid 1970s. On the government side, so I think at this point everybody agrees that our budget deficits are on an unsustainable path, except some fringe groups which argue that budget deficits do not matter, but they also have some non-conventional views. For example, even eliminating the income tax and government basically spending as much money as it wants. But in that case, the government would also be able to just sort of, own or confiscate the entire financial system. But that's a fringe view. National debt is rising also accordingly because, every year's deficits actually go into increasing the national debt. And we are adding close to $2 trillion per year, which is not sustainable. So the fiscal cliff seems more closer than ever. So at some point, some hard decisions will have to be made, assuming that the government is not going to default on its debt, which there's no reason for the government to default because they have the money printing, mechanism, so they can print as much money as they want to pay off the debt, which would result in inflation. So that's one outcome. And also to tackle the issue, we'll have to, at some point, maybe not in too distant future, have to increase taxes and or go through some deep government spending cuts. Also on the foreign trade side, so the U.S. economy is a twin deficit economy, which means that we don't only have a budget deficit, but we also have a huge trade deficit, around $1 trillion per year, which means that Americans consume way more than they produce. Like I said, around $1 trillion per year overconsumption. And tariffs, of course, that's the buzzword over the last few months. So we don't know where they are going, but the general consensus is the end of, or at least, globalization as we have known it is pretty much over. So it's not gonna fully disappear, but it's gonna take some different shape and form. On the market side, we have right after the new administration came into office, there was this exuberant period and emotions in financial markets. So that's the greed period. But now we are actually on the opposite side of the spectrum. Now we are in extreme fear. So yeah, and it took only a few months to go from extreme greed to extreme fear, which is definitely not healthy. And the rise in gold prices is another testament to this extreme fear because gold prices tend to increase during times of turmoil as a last resort of an investment when investors think about only one thing, not necessarily making money, but preserving their capital. So interestingly enough, the market has entered a correction. This is the equity market, the stock market, S&P 500 and NASDAQ. And in fact, NASDAQ even entered a bear market, which is a 20% decline from the peak. The correction is a 10% decline from the peak, but things also reverse so fast. And in fact, something really historical took place just last week. The market two times, or the difference between on a given day, the trough and the peak in the market exceeded 10%. So it went from one day, it went from negative 5% to positive 5%. And on a different day, just a few days later, it went from, I think, positive 1% to positive 12%. So those are unprecedented moves, which tells you that there's a lot of turmoil in the market. Having said that, even after this correction and a very short bear market, by many measures, the stock market is not actually cheap, which, something we have observed for a long time. A lot of people acknowledge that there are a bunch of financial bubbles, which are happening at the same time. And we don't know when they will burst or whether or not they will burst, but the stock market is still, it seems like it is not cheap. So it might still be in a bubble status. And then the last thing which I highlighted here is the most important measure that not necessarily the public is paying attention to. This is the yield on 10-year treasuries. But the smartest money on Wall Street is not stock investors or traders, equity traders, but it's actually bond traders. So that's the smartest money on Wall Street. And it's pretty clear that the turmoil over the last couple of weeks was not necessarily because the stock market was going down. The stock market was just responding to the rise in 10-year treasury yields, which created a lot of stress, especially for hedge funds and highly leveraged Wall Street investors. All right, so let me just check my time. Okay, so I'm just going to go over some important slides I have put together. I'm sorry, not slides, some charts. And if you'd like, just send me an email and I can send you these slides along with the charts. But they basically come from mostly from different branches of the Federal Reserve, which put together very detailed financial and economic information, along with Bureau of Labor Statistics, the Treasury Department, and some other prominent private sector data sources. All right, so I'm just gonna close this. All right, so I'm gonna start with the latest outlook on the GDP side. So Atlanta Fed, again, one of the branches of the Federal Reserve, has this method they develop which at least attempts and tries to measure GDP in real time. It's very volatile. Definitely very volatile, but it gives you some idea of at least what the current sentiment is on the GDP side. So as you see here, based on their current calculations, we are in a significant recession. So once the tariff problem emerged, there was a deep dive into the recessionary range. So yeah, by some measures, maybe the economy has started shrinking at a rate of anywhere from 3 to 2%. As I said, this is very volatile, so it can actually change and start going up very rapidly. But also on the market consensus side, maybe the economy is not in a recession, but it has definitely slowed down. So maybe, it's from a 2.5% growth. Now the current projection is 1.5% growth, which is a pretty significant drop. There are some other measures, especially this one. This is produced by the Philadelphia Fed. So the Midwest is still, somewhat at least the hub of manufacturing. So if you look at the latest drop here, a huge decline in the manufacturing activity, because a lot of businesses, they cannot really foresee even the near future. So one response is just to definitely stop, any investment projects, but also just put everything on ice for some time at least. Consumer sentiment is also very important. So this is a long-term, or rather, a statistics that has been around for a very long time. So this is collected by the University of Michigan. Consumer sentiment. So as you see, there's a huge drop lately in consumer sentiment, to the point where the current level is actually worse than what it was back in 2008, 2009, or during the financial crisis, global financial crisis, or even reaching to the low points of the pandemic. This one is also pretty volatile. So, Trump decided to rescind some of the tariff rules, so it can actually start going up, but at least it had a huge impact on consumer sentiment. And why is this important? Why do we really pay a lot of attention to what consumers think or feel about the economy? Because if you look at this graph, consumption, personal consumption, constitutes close to 70% of our economy. So if there's any drop in consumer spending or even just the sentiment, that can very easily put us into a recession. And the US has one of the highest personal consumption rates as a percentage of the GDP, which tells you that our economy is definitely a consumption based rather than investment based. Just to give you an idea, so here we're looking at a 70%, close to 70% consumption as a percentage of the GDP. This rate is this percentage is only 40% in China, for example. In the US, investment as a percentage of the GDP runs around 17% or so. In China, it's about 40%. So, so consumption is not a strong pillar of the economy in China, but here it is. But China relies on actually lower consumption by households, saving the unconsumed portion of earnings, and investing. That's how their economy operates. On the unemployment side, we're looking at some historical graph here. So as you see, unemployment is still pretty low by historical standards, so around 4% or so, but it has been rising at least modestly. But again, the labor market seems pretty strong. If you look at job openings, so it looks like we have cleared that club caused by the pandemic. After 2022, job openings started going down. So at its peak, there were 12 million job openings, which means that employers could not actually, find at least the right people to to fill those positions. But it has been declining since then, which means that even though the market is still pretty strong, the labor market, it is becoming, I guess, less strong. So those openings are filled more quickly. All right, so on the inflation side, again, as inflation peaked back in around 2022, 2023, it has come down quite a bit, but it's not low enough yet, or it hasn't come down as much as the Fed hoped, because the Fed has a 2% target. So they try to keep inflation around 2%, maybe a little bit higher or lower. But we have not been in that range for some time. So, and there are a lot of signs that inflation has become pretty sticky. So this is one measure. Consumer prices, which includes more volatile components, food and energy. So right now, at this point, it's standing definitely above 3%. So if you think about it, if the Fed has a 2% target, where we stand right now is 50% higher than their target, more than 50% higher than their target. So that's the sticky inflation, which makes the Fed very nervous because if the inflation stays sticky, and if the economy further slows down or maybe enters into a recession, the Fed is really stuck in the sense that if they lower interest rates, then inflation is going to go up further. And if they don't, then the recession will become more serious, or maybe at some point will start creeping into that at least some semi-depression status. So that's the dilemma the Fed is facing, because they haven't discovered how to fight high inflation and low growth at the same time. So they can do it. They can fight one or the other, but yeah, we don't know how to fight both at the same time. Services inflation is especially problematic, has been. It's close to 4% services inflation. So it has always been higher than inflation in goods, but again, tariffs will actually make goods more expensive, and the U.S. imports a lot of goods from especially China and in general other countries. So now goods inflation will be similar to services inflation, which is actually very sticky. And the last chart here is, again, University of Michigan's, this time inflation expectation data set. So as you see, lately, there has been a huge jump in inflation expectations of consumers. So it was around, let's say, a little over 2%. Now it's over 4%. So huge jump, which again, I guess, a rather rational expectation on the side of consumers, but consumers are typically, or their expectations and sentiments are volatile. So this might actually come down pretty fast. All right, so I'm gonna, I still have around maybe 10, 15 minutes. So I'm gonna show you some charts about budget deficits. This is federal budget deficits. So as you see, it has become, it has definitely been unsustainable for some time. So typically this issue has become very chronic after the financial crisis, and COVID crisis made it even worse. And so obviously we are, in a peacetime, and economies tend to countries tend to run deficits during wartime. But even though there has not been any, major wars over the last 10, 15 years, we have been running some, huge, huge deficits. So as it stands, it's about 6%, which is very high, so if you look at here, going all the way back to 1940s and stuff. So at the beginning of the Second World War, as the U.S. was actually, getting ready for the war in two fronts, in Europe and in the Pacific, they started running some deficits, which, we are actually running those sort of deficits at the same level in peacetime. So that's a problem. So it's around 5-6% of our GDP, which is very high, and it's a unique situation among other advanced economies. So the question is, what happens to those deficits? So we're close to $2 trillion just last year, and going forward, most probably this year, close to $2 trillion. So what happens is basically these deficits are added to our national debt. So at this point, we are adding $2 trillion to the existing debt. So here's another chart. So how do we really make sense of national debt? Since it's such a huge number, we're looking at $36 trillion at this point. So it's very difficult to make sense of. I mean, it's a large amount, but how large is it, or how bad the situation is? You just compare your national debt to your GDP. So at this point, debt as a percentage of GDP stands around above 120%, which is also pretty unique among other advanced economies. And in fact, it's the highest among advanced economies, except Japan, but Japan has a special, it has special circumstances, which we can't really go into those. But at least when I was going to school to get my PhD at the time, so that was early 2000s, the consensus was 60% in terms of the upper limit. But yeah, we have exceeded that 20%. This website that I sometimes show to my students is there are a lot of numbers here, but it's usdebtclock.org. So it is actually pretty enlightening, I guess in a pessimistic sense, where we stand in terms of our national debt. But I'm just going to point out one thing here. So interest on national debt at this point actually exceeds $1 trillion. So, and that's a very high number. I mean, $1 trillion, it's not a necessarily meaningful comparison, but it exceeds the GDP of virtually all countries in the world. So $1 trillion is a pretty big sum. And as the debt grows, we're actually, paying more on interest. So this is the picture on the trade deficit side. So again, the U.S. is a twin deficit economy. On top of the budget deficits, we also have a big trade deficit. So these are billions of dollars. So at this point, we are around $1 trillion in trade deficit. So our exports or our imports exceed our exports by $1 trillion, which means that we are consuming $1 trillion more than what we produce. So what happens to these trade deficits? Well, before that, actually, again, just to make sense of our deficits, it's good to look at deficits as a percentage of the GDP. So at this point, we're running, around 3% of deficit as a percentage of the GDP on the net exports side, which is pretty significant. So again, what happens to those yearly trade deficits? What happens is this. So we keep owing more and more as our yearly trade deficits accumulate. We just keep owing more and more to non-US non-US people, let's say. So people from other countries. So at this point, we're looking at around $26 trillion. So that's net investment, which is a negative number, net international investment position of the U.S. Of this, we owe around, I guess, $8 trillion or so, $7-8 trillion directly, or the government owes $7-8 trillion, the federal government, of money to foreign investors, non-US investors, in the shape and form of basically bonds and treasuries. And beyond that, the rest, $20 trillion of US assets are owned by non-US people or foreigners. So that includes stocks or real estate or physical investments. Some people say that that's no big deal. Some people say that it is a big deal. But whatever your view is, this number keeps rising, and it'll keep rising unless the trade deficit shrinks a little bit, at least. And finally, I have some slides about the market. So this is the famous CNN Fear and Greed Index. Just a week ago, it was as low as 3, which was the lowest I had ever seen, ever. So we're still in that extreme fear segment, but since since the administration, Trump, reversed some of the tariff policies, at least temporarily, there has been some, I guess, some optimism rising in the economy. Again, gold prices, it's a rising gold prices, an indicator of certainly more fear in the economy, and investors are in a capital preservation mode versus trying to make more money. So this is the S&P 500 chart. It's a 5-year chart. So there was this huge drop. But since then, interestingly enough, there has been some, significant recovery, including today. And that was due to the pause, the 90-day pause on tariffs. And in fact, just over the weekend, Trump also exempted a lot of electronic products, at least again temporarily. So that just increased the optimism in the market as of today. As I mentioned, the market. The stock market, the equity market is not cheap, even after this big drop. The famous Buffett indicator, Warren Buffett, which uses this indicator to maybe increase or decrease his exposure to the market. And in fact, over the last year or so, he sold 30% of his assets and now keeps that 30% in cash, basically. Market cap, so that's the total value of the stock market to GDP. So a higher ratio means that the market is expensive and vice versa. So even after the drop, if you look at here, and so this is actually as of last week, it went up quite a bit over the last week, the market. So we are standing somewhere here. So which is a historically high. If you look at the average, it's around here, which corresponds to maybe the value of the market and the GDP are approximately the same. But here we're looking at maybe the market twice, the value of the market twice the GDP, which is definitely in the bubble territory. On top of that, now we have this enormous concentration in the stock market. Top 10 firms, including obviously the Magnificent Seven and three others, they make up around 1/3 of the market. So that's a huge concentration. So there are those 10 firms versus 490 firms, and they are behaving completely differently. I'm going to skip this. And finally, this is the first thing I look at every morning. This is the historical chart, but I look at it on Yahoo Finance. So basically, the yield on 10-year treasuries. The consensus is that the U.S. economy is so highly leveraged. We have so much debt on the government balance sheet or household balance sheets that things start breaking, not only in the U.S., actually, internationally, given the dollar's reserve currency status. Things really start breaking. The system starts breaking down if or when yields get closer to 5%. So when that happens, and it has, a number of times over the last, few years or since the COVID crisis, 3 or 4 times, we got very close to 5% yield on 10-year treasuries. And each time some segment of the U.S. economy or even global economies started, breaking down, showing some signs of high stress. And there's this expectation that if that happens again, then the Fed will, step in and, come to the rescue, which creates, other problems, of course. But yeah, this is something I pay attention on a daily basis. Pay way more attention than the stock market, because the stock market actually responds to this chart. All right, so this is all I have. So I'm just gonna stop sharing my screen. And then, yeah, we'll open the floor to questions.
Hi, Brock. This is Katie. It looks like we have a question asking the following. Please discuss the relation between equities and 10-year treasury yields. Very interested in understanding the relationship and why yields increased while equities were dropping.
Okay. The relationship is pretty complicated, but as I mentioned, it's a relationship. It's an indirect relationship, which is related to the high leverage in the economy. So there are a lot of investors holding trillions of dollars of U.S. debts, those U.S. treasuries, and the relationship between the value of those treasuries and interest rates is inverse. So as interest rates go up, the value of those bonds decline. And when that happens, a lot of those parties, whether they're international or here in the US, they start selling their bonds to cover their positions, their leveraged positions. So basically, a rise in interest rates lowers the value of bonds, and it creates this downward spiral when you are selling more and more of those less valuable bonds, which keeps increasing the impact of the rise in yields. So, like I said, this is a very complicated matter. But if you go to YouTube, and I can recommend some people explaining this, at least the latest episode of the rise in yields and its impact. But just one more sentence here. There are a lot of extremely leveraged, and I'm talking about 1 to maybe 50 or 100 leveraged hedge funds investing in the bond market. Without going into technical details, when those yields rise, they start losing money very fast. And we're talking about, they invest maybe $1 of their own money and borrow $50. So creating a lot of leverage. And those trades turn sour very quickly because of the leverage and because of rising yields. And when that happens, of course, the rest of the market inevitably is affected. And the reason, a lot of people say that the real reason why Trump decided to reverse his course was not the stock market, but it was the bond market, because he got a lot of warnings, especially from his Secretary of the Treasury, Bessent, that if we keep on this current course, that will basically cause another 2008 style financial crisis.
Thanks, Brock.
Yes.
I'm just checking the live questions here. So here's another question that came in advance. Any thoughts on stable investments moving into 2026? If you have any information about economic theory related to some of Trump's actions, that would be appreciated.
I mean, there's definitely some economic theory behind it. So tariffs are not new; they have been around for centuries. Uh, but the reason that they created so much turmoil, I mean, there are a lot of reasons, but the economy, the U.S. economy, has been very fragile. So whenever you just move some of those pillars of the economy, even slightly, things just started shaking too violently. And basically, the main premise of the administration's tariff policy is related to that chart I've shown you. So we just keep owing, or we just keep having the assets in this country being owned by foreign peoples or entities or governments. That bothers some people, and some others are okay with that. So that's I guess, a political maybe stance. That's one. Plus, as I've already, as I have mentioned a few times, our economy is very dependent on consumption. So, one of the goals is to actually increase investment in this country, which will reduce our reliance on consumption. So increased investment will, create new factories. I don't know, maybe not necessarily low tech, but on the high tech side. Create employment, at least some manufacturing related employment. And then, yeah, just, make our economy more resilient. So it's not going to be just based on consumers, but we will have other stronger pillars carrying the economy, investing and accordingly manufacturing rather than services. So that seems to be the economic, explanation or motivation. In terms of stable investment options, honestly, cash. Well, when I say cash, it's not just cash in a checking account, but short-term treasuries, and I'm talking about 3 to 6 months. They pay around 4.2%, and they have virtually no risk. So yeah, if some people are just fed up with the turmoil and they just said, okay, I'm just going to take a break. This is just way too stressful. Um, but yeah, I mean, 4.2% just sitting on the sidelines is not, is not too bad, So that's probably uh, one safe haven. Some people, have been investing in gold, but I don't know, that one is not, I mean, that can, be volatile too.
Great. Thank you. Okay. We've got just a few more minutes, so if there are any questions, just a reminder that these do come through anonymously to the larger group in attendance. So it is just those of us administering this webinar that can see those questions. So happy to put those forward through to the group.
I remember seeing a question about cryptocurrencies, but I honestly don't know much about. I don't follow cryptocurrency uh, related things too closely, so I don't honestly know.
There is a question about China and the tariffs that reads the this person states the linchpin in the tariff scenario seems to be China. Can China mastermind a world presence and be the powerhouse of the world? It's a pretty broad question, but
Yeah, I mean,
I'll let you take that on.
it is already a powerhouse on the manufacturing side, no question about it. I mean, they basically stand in the middle of this global manufacturing supply chain. So they are called the factory of the world. So so they have definitely accomplished that. But when it comes to dominating other aspects of the globe, it definitely takes more than just manufacturing. I don't know if China has those sort of ambitions, just dominating not manufacturing but other important aspects of the global power structure. I'm not sure, but if you have those ambitions, manufacturing seems to be the place to start. Well, not just manufacturing of low-end goods, but manufacturing of both. And China has accomplished just that. They started small, just manufacturing a lot of low-end consumer products. But by some measures, I was reading this stats or this research done by some group in Australia. So they determined, I think, 55 or so major technological areas. So whether it's semiconductors or aviation and others, and at this point, I think China dominates, or is number one at least in. I don't know. I'm going to say 47, 48 of those 55, and this is on the technological side. And 20 years ago, I think they had virtually no lead in any of those areas. So that's quite an accomplishment. But yeah, I don't know. I don't know what their goal. Nobody knows. So yeah. Oh, Katie, you're muted.
Oh, thank you so much. I know we have just a couple minutes, but we've got a few questions that have just come in. So first, do you suggest continuing investing in 401k accounts, or should we hold off on deposits until the market settles and becomes less expensive?
It depends. It honestly depends. I know this is a very generic answer. It's like a quick escape, but it honestly depends. So if you are only, 25 years old and you expect to be working for another, I don't know, 40 years, 50 years, then yeah, you're not going to be affected by all these ups and downs. And maybe you don't even have that much money, invested. in markets versus somebody who is, getting close to retirement. So again, it just depends on so many factors. Some people are very good at dealing with turmoil and stress. Some others are not. So, they might actually get discouraged maybe, a few months into some stock market turmoil and just sell everything. And maybe a few months later, seeing that, everything just, bounced back up. So, yeah, it's tricky. It's definitely tricky.
So one last one, and then I think we'll have everybody get back to their work day or their school day, whatever the case might be. So what is the significance of the timing of the tariff changes? Essentially, why rip the Band-Aid off now versus kicking the can down the road with the deficit?
Yeah, I guess, I mean, it looks like, yes, we have been, kicking the can down the road for a long time, but it looks like we are really, really coming to the end of the road. So that could be a reason. Um, so yeah, I'm not sure whether how much longer we can, I mean, I've shown you the charts, so a twin deficit economy. I mean, how much longer we can just postpone at least attempting to find solutions. And new administrations, they always come in with some agendas and they try to accomplish as much as possible during the first couple of years before the midterm elections. So they just want to push their agendas through as quickly as possible. And there's going to be pain, clearly. So maybe the initial strategy was, and still is perhaps to a lesser extent, is to just push everything through rapidly, go through some time of pain, but hopefully, experience some sort of a recovery before the midterm elections. And that's the playbook of Reagan. That's what he did back in early 80s. If you look at the charts, actually, the economy was also in turmoil, but his gamble paid off. So he stopped those negative trends before the midterm elections, and then the Republicans actually did pretty well during the midterm elections in 82, 83.
Great. Okay, well, we're almost to the top of the hour, and I just want to say thank you so much, Dr. Dolar, for your well-researched presentation. From all of us at Western and from the MBA program. Thank you to those of you that joined and for carving out part of your day to join us for this conversation. Finally, a special thank you to the Foundation for WW and Alumni Office for their partnership on this project. Without the outreach to our alums and our friends, this event would not be possible. So if this time piqued your interest, be sure to check out our upcoming Accounting and Finance Certificate program. It's offered on weekends during the month of May. Registration is still open, and you can reach out to either of us with any questions that you have about that, whether or not it might be right for you. And we will send a recording of this webinar out in the next few days, so check your email box and feel free to share with colleagues, friends, family, whoever might find it interesting. I think most people would. So without further ado, thanks so much. Have a great day and take care.
Bye.